is 12 p.m. in London, 7 a.m. in New York and 8 p.m. in Hong Kong. I'm Anna Edwards and this is Bloomberg Markets. Our top stories today. Stocks mixed as traders weigh a global advance in Treasury yields and a potential March rate hike from the Federal Reserve. The advance of the Omicron variant, the start of earnings season and a boom in M&A also colour investor sentiment. Fresh turmoil for Credit Suisse. The banker tasked with fixing the company was ousted just 9 months into the job for breaching COVID quarantine rules. Shares falling on that news. And surprise rate cut by China's central bank. Growth slowed in the world's second largest economy. Consumer spending took the largest hit in December as the government tightened virus controls. All that and more coming up. Welcome to the programme, everybody. Welcome to Bloomberg Markets. But first, let's get a check on the markets. A day, of course, when we don't have US equity markets in play. We have, of course, European equity markets very much in play. And you can see European equity markets moving to the upside, up by 0.6%, but actually playing a little bit of catch-up with what we saw in the United States on Friday. As I mentioned, it is Martin Luther King Day, so no trading of equities in the US, also no trading of cash treasuries, although we have a sense of where things head there from the futures, and it is a continuation of the higher yield story. I put in the yen here as well because the BOJ looms on the agenda this week. Could the BOJ change its view on price risks for the first time since 2014? And talking of 2014, I put in the Brent price as well. The price of a barrel of oil, 85.75, and that is threatening a 7-year high. That would be the highest level since 2014, and that is something the market is very keenly watching, of course, all the way through 2022 so far. We've seen strength coming through in the energy space, strength coming through in commodities, an 11% or so increase in oil prices year to date. I also put in, just on that chart, we had the Unilever share price, which I can tell you is moving to the downside. A lot of concern that this consumer goods company might be tempted to overpay for the consumer arm of GSK. Will they come back with a fourth bid? We'll talk about that as we go through the programme. But that stock down by 8%, and that is heavily weighted here in London. Now, for the latest commentary on the markets, let's get some analysis. James Athey, Investment Director and Senior Portfolio Manager on the Global Rates team at Aberdeen, joins us. James, very good to have you with me. I was going to say this morning, force of habit, this afternoon here in London. Let me talk to you about what's going on Treasury markets. We don't have Treasury trading, of course, today, but it is to some extent turning into a global narrative, and it is something that, of course, we will be focused on a lot as we go through this week. We've heard from Jamie Dimon over at JP Morgan, who's talked about the possibility of, we could have 7 hikes this year. What is your expectation for the Fed in terms of the number of hikes? What's the number you have penciled in?
It's difficult, Anna. Yeah, morning or afternoon. It's difficult because there's going to be some interplay, I think. I'm minded to think of that ancient philosophical thought experiment. If a tree falls in the forest and there's no one around to hear it, does it make a sound? It's very similar with respect to Federal Reserve policy here. If the Fed indicates a load of hikes and financial conditions don't tighten, did they hike at all? And I think that's the challenge which the Fed is facing at the moment. That they've told us in quite a short space of time that they have shifted their expectations for policy tightening aggressively. They've, 6 months ago, really, we weren't talking QT at all, and we were talking maybe 1 or 2 hikes, and now 4 are priced for 22, and we're talking about quantitative tightening. And financial conditions have not moved much at all. By one of the sell-side banks' financial conditions index, they're about 0.3 tighter, but that still makes them roughly 3% easier than they were at the end of the last tightening cycle in 2018. And obviously the growth and inflation pictures are vastly different. So the Fed is not tightening policy by its own metrics if financial conditions are not tightening, and that can create a problem for them. I don't think they want to be too aggressive too early for fear of destabilizing financial markets, but by the same token, if their communication and their policy changes are not having traction, they are pretty much mandated to do more while ever inflation is elevated and the labour market is tight. So right. I think 4 is quite reasonable at the moment, and actually we've been taking risk off in the 5-year bucket, where we've been pretty short. We've been taking risk off because we've moved a long way quickly, but in the end, it wouldn't surprise me if they only had to hike 2 or 3 times, and it wouldn't surprise me if they had to hike 5 or 6 times.
Okay, so a lot still to be seen then, James. We have seen the market, though, and analysts adjusting their expectations. I think the average expectation is now for more than 4, maybe not quite 5, but more than 4 hikes in 2022. We've also seen a lot of people commenting on whether we need some kind of shock to the system, James. And I wonder if you see any narrative, any sense to this kind of narrative. We heard Bill Ackman talking about how maybe we need 50 basis points in March to restore credibility. Just last week, we were talking about Henry Kaufman, the 1970s Wall Street Dr. Doom, who was talking about we need it to change the market's inflation attitude, and that will require a shock to do that. Is there an argument that we need some kind of shock therapy, or does that not make sense?
No, I do think there is some sense in that. I think one of the problems the Fed faces is that financial markets have been conditioned for so long to expect a low inflation, low growth, easy monetary policy equilibrium whereby every dip in risk assets is bought, blindly without really any consideration because, the Fed put exists, the Fed is there to save you, and there is no threat to that scenario because inflation is so benign. And that's a danger. Conditioning investors in such a fashion really is not healthy for the financial system. It's not healthy for price discovery. It's not healthy really for the transmission of policy. And so I do see the sense in shocking markets out of that. Of course, you run the risk then of creating a very precipitous unwind of some of these positions and really queering the pitch such that you can't really manage the inflation outlook because financial markets are so destabilized. So I don't think you want to be too aggressive, but I do think it's interesting that we are discussing a 50 hike. I mean, realistically, after the January meeting in a week or so's time, you're down to 7 meetings left for the year. And if Jamie Dimon's right, the Fed wants to hike 6 or 7 times, then every meeting is live, or you just need to get off to a quicker start. I'm gonna look at the RBNZ, who've been way out in front in terms of their hawkishness and communication and policy changes. Lots of talk about them doing 50, and twice they have passed up the opportunity to do 50 and done 25. To me, that's probably representative of, in general, how careful and cautious central bankers are. It would be a big shock at this stage, I think, if the Fed went 50 as soon as March. But I do see the rationale behind this idea of a shock to the system to sort of shake investors out of this conditioned behaviour.
Yeah, would there need to be a catalyst for that kind of action, though? It's easy when we see the onset of something very negative. We have plenty of experience of central banks cutting rates quite aggressively, more than 25 basis points, to try and kickstart things, to give a very serious message to markets. It's harder to see the catalyst that would provide the arguments for doing that, maybe, on the upside.
That's absolutely right. And again, that's 30 years or so of learned behaviour. Central bankers have been unbelievably asymmetric in their response to incoming information. Exactly as you described, the minute there are signs of trouble, central banks are happy to cut 25, 50, 100 and more and grow the balance sheet in gargantuan fashion. They've not really had to face a sort of positive shock, if you like, the sort of shock that might require an aggressive hiking of policy. We see it going on in emerging markets over the last 12 months, where various central bankers have been hiking by 100, 150 at a time, and we're more accustomed to that. Would it need some sort of upside shock? Yes and no. I think if inflation pressures persist, if the signs of second round effects, i.e. ultimately wage negotiations and wage changes being at least equivalent to the changes in headline inflation, then and equity markets are still up here, financial conditions are still loose, then that's, I think, the sort of scenario where central bankers and the Fed will be thinking their credibility is significantly on the line, and maybe that's a trigger for them to really openly start considering more aggressive changes to policy.
OK, that would be something really interesting to watch. So given all of that, and given how much uncertainty there is about the year ahead then, James, if you could see arguments for just 2 hikes and also a situation where we ended up with more than 5, if that's the range of possibilities still ahead for us in 2022, how do you position for that kind of uncertainty?
Yeah, so for me, there are a couple of trades which still offer you quite attractive asymmetry, even in a quite bimodal distribution, if you like. So yield curve flatness in the US, sort of been banging on about those for quite some time. Obviously, it worked very well through certainly the second half of last year. I still like that as a way to position for the potential for much more aggressive monetary tightening, a base case of a significant amount of monetary tightening. But a risk, a tail risk for some, a more considerable risk for others, including myself, that actually growth and inflation might disappoint more significantly versus expectations. All of those environments, I think, given where we are today, are likely to weigh on the yield curve. So yield curve flatness in the US, 5s, 30s, I think is a good expression. A similar dynamic for break-evens in the US. Longer dated break-evens here are still somewhat above the Fed's target, so suggesting that inflation will run above the Fed's target on average for 10 years, when in reality the Fed is responding in real time with quite aggressive changes to its policy communication. So if inflation does not come down on its own through this year, I think the Fed will be mandated, if you like, to respond one for one with policy tightening. And policy tightening tends to weigh on longer dated break-evens. So either inflation comes down on its own and break-evens look a bit rich, or inflation doesn't come down and the Fed has to tighten, and that should cap or reduce longer dated break-evens. Risk asset performance, if it is wobbly and negative, will do likewise. And the dollar, I like the dollar for similar reasons.
James, thanks so much. Really good to speak to you. Thanks for joining us. James Athey of Aberdeen, thanks for spending time with us here on Bloomberg Markets. Now, let's get to some first word news for you. Get an update on some of the top stories that we're covering here at Bloomberg. Here's Angel Feliciano. Angel.
Anna, Credit Suisse has ousted its chairman after reported breaches of Swiss and UK quarantine rules. Antonio Horta Osorio resigned after just 9 months on the job. His exit follows a disastrous year at the Swiss bank. 2 scandals cost Credit Suisse more than $5 billion and hammered the stock price. Board member Axel Lehmann has been named the new chairman. In China, the central bank has cut a key interest rate for the first time in almost 2 years. Beijing is trying to bolster an economy that has lost momentum because of a property slump and repeated coronavirus outbreaks. Official data show that China's gross domestic product rose 4% last quarter from a year earlier. That's the weakest since early 2020. And for the 4th time this month, North Korea has test-fired missiles. South Korea's military said that Kim Jong-un's regime fired what appeared to be 2 ballistic missiles into waters off its east coast. The task could be a way to force the Biden administration to come up with a new strategy towards Kim. And the new Omicron variant has now spread to major cities in China. Beijing, Shanghai, and Shenzhen have all reported cases. While they are small in number, the infections are causing concern because of their timing. The Lunar New Year begins February 1st and is marked by mass travel. And the Beijing Olympics begins 3 days later. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Angel, thank you very much. Angel Feliciano joining us there with the latest top stories that we're covering. And along with that, we should throw in some corporate news flow and some M&A speculation, or at least, well, confirmation that the M&A is being talked about. Whether it will actually go through is uncertain. So Unilever is considering upping its $68 billion, that is a £50 billion bid for GlaxoSmithKline's consumer unit. And could this mark a pivot towards health and hygiene for the Unilever business? How will that go down well with shareholders? Well, it's not going down well today, that's for sure. The share price of Unilever down by 8% in today's session. We'll get some further analysis of what is motivating Unilever to engage in this conversation. And China's economy actually grew faster than expected, but the PBOC surprised some by cutting rates. More on that ahead. Plus, could Partygate topple Boris Johnson? We discuss how the scandal of breaking COVID rules is engulfing the Prime Minister and threatening the stability of the Tory party, not weighing on the pound, though. This is Bloomberg. Welcome back to Bloomberg Markets. It's just gone 17 minutes past 12 here in London, 17 minutes past 7 if you are in New York. Now, Unilever plans to sharpen its focus on health and hygiene and sell off slow growth brands. That's as it weighs whether to make a higher offer for GlaxoSmithKline's consumer unit. Let's get more with Bloomberg's Joe Easton, who joins us with the latest. Joe, the latest would seem to be the market reaction to all of this weekend news flow about Unilever making 3 offers for this unit of GlaxoSmithKline. And the reaction has not been positive in the share price, nor from some of the analysts we've been speaking to. Give us a flavour of some of the negative response.
Yeah, so I mean, analysts pretty much negative across the board, really, and I don't think it's too surprising when you look at the money that's being quoted. So obviously, around £50 billion is the touted offer price. Given that Glaxo have sort of shrugged at that, it could potentially even go up to 60 billion. So that's a really high multiple. When you look at the unit, it would value the unit around 20 times earnings. Even companies like Reckitt and Procter & Gamble in the US trade lower than that, and that's at the 50 billion valuation. Like I said, if it went further, you'd be getting to even higher multiples. So you can understand why investors and analysts are kind of saying this doesn't seem to make sense. Also, just in terms of synergies, there's a big difference between making Marmite and mayonnaise versus making painkillers. So you're kind of questioning where the overlap is in these businesses. So therefore, analysts, not liking this one at all today.
But the Unilever stable is already quite broad, and yes, it makes the sort of like it or loathe it products like Marmite and also mayonnaise and washing powders and things. But it also makes beauty products, and that's been a push for the business, and they've been trying to get out of some of the slower growth areas of food. There are those who have been calling for this kind of deal, I suppose, and must see some strategic sense to it.
There are areas for growth, particularly in the consumer health area. So a lot of emerging markets are still underpenetrated, and consumer health is becoming much more important, not just in the developed world. That's something that obviously the pandemic has helped to accelerate as well. So there are big areas of growth. So it's not necessarily that it doesn't make sense in terms of sales, but at the prices that they're talking, it seems like Unilever is really going all out and trying to get this unit, and investors kind of don't see that as being a necessity in terms of their strategy. So there is reasons for it in terms of growth, but the price is what's being balked at here.
Yeah, even though Unilever making that statement this morning saying they will, employ financial discipline, trying to reassure the market in that sense. What about from the GlaxoSmithKline perspective, from a GSK perspective? They've been under investor pressure, activist investor pressure to try and to open themselves up to this kind of offer, whereas the plan, I understand, was to spin off in some other way, to possibly IPO this consumer unit. What's that perspective?
Yeah, exactly. So the plan was to IPO or spin off and put that into the public market. But obviously the issue there is it's so much uncertainty. You don't know how markets are going to react. By the time they go through the whole process of setting up the IPO, will there be an appetite? There's so much uncertainty. It would be so much better for GSK and for investors if they could just sell it in one lump to a company like Unilever. So we can see, the GSK share price jumping today. So that is beneficial for them. If they could do the deal, it would be beneficial at the right price. They obviously seemed like they would hold out for a higher price. You could potentially see somebody else coming in. Some analysts are touting that there could be a counter bid for somebody like Reckitt or one of the other big giants, even private equity. So I wouldn't say it's over for now. GSK obviously looking to refocus on oncology, cancer treatment, also vaccines. They really missed out on the vaccine push during the pandemic. So looking to move away from consumer health, focus on the main drugs business. So probably just looking to get the right price, I would say.
Yeah. You wonder whether some of the big US names might be looking at this one as well and potentially thinking about getting involved. Joe, thanks so much for joining us. Bloomberg's Joe Easton joining us with the latest on Unilever and its pursuit of part of GSK. Let's turn to another corporate story here in Europe that's really making headlines. Credit Suisse Group's chairman, Antonio Horta Osorio, has resigned after just 9 months in the role. This is following a series of missteps, including reported breaches of Swiss and UK quarantine rules that eroded confidence in his leadership. Joining us now is Bloomberg's Michael Moore. Michael, help me understand exactly what's going on here. What are the breaches of COVID rules, or what are the infractions that he's said to have committed here that have led to this resignation?
Yeah, so he has already apologized for breaching Swiss quarantine rules. He came in to Switzerland from London and then left before the required quarantine period was up. Media publications have also reported he attended Wimbledon this summer when he should have been in UK quarantine. So this all came to a head because, he was brought in to drive this cultural change at the bank. His message was all about personal responsibility, and having, himself in the spotlight here was something that I think the bank and he felt was not sustainable. So he resigned. It was quite a surprise. Most people had expected somewhat of a slap on the wrist for this.
Right, yes. I mean, I suppose yes, you might think maybe a slap on the wrist. I suppose, though, when you're brought in to manage risk and to improve risk management, if you become a risk, that's not a great look. What about the leadership vacuum that potentially was opened up here, although we have seen the Swiss bank announcing pretty quickly a fix for this?
Yes, so they've replaced him with Axel Lehmann, a board member who just joined Credit Suisse's board late last year. So relative newcomer, but is well known in Switzerland, having been at UBS and Zurich Insurance. But you have at the top of the bank now 2 Swiss executives who were put in kind of an emergency situation. Obviously, the CEO, Thomas Gottstein, came into his role after the previous CEO was ousted over Credit Suisse's spying scandal. The top of the bank are a couple of gentlemen who came into the roles pretty quickly.
Yeah, absolutely. And after the spying scandal, then there was Archegos and a big focus on risk management as a result. Michael, thank you so much for bringing us the update. Share price of Credit Suisse down by 1.7% in a market that is broadly rising. We're up by 0.6% on the Stoxx 600. Thank you very much to Bloomberg's Michael Moore for bringing us the latest on the Swiss banking sector. And as he pointed out, a surprise announcement there from Credit Suisse with regards to the chairman. Coming up on this program, Chris Turner, head of foreign exchange strategy at ING Bank, joins us next. We'll talk about the dollar. Has the dollar done exactly what you thought it would this year? And if it hasn't, get involved. IB Plus TV Go is the function to use if you want to get in touch with us. We'll put your questions to our guests. We'll think about where the US consumer heads from here, what role that plays on the dollar. Also, go around the world in currency. This is Bloomberg. Welcome back. This is Bloomberg Markets. I'm Anna Edwards. It's just gone 12:30 here in London, 7:30 in the morning if you are with us in New York. Of course, it is Martin Luther King Day, so we don't have trading in the United States today on equities or on treasuries, but we're here in full complement in Europe with plenty to talk about. Let us get to the markets. We have, just check the markets for you, we have the Stoxx 600 moving up by 0.6% this morning. We'll ignore perhaps US futures for the moment because, of course, we're closed on US equities. But we do have a move to the upside here in European equity markets, up by 0.6%. The FTSE outperforms, up by 0.8%. US futures, as I say, it won't hold too much store by those, but they are pointing to the upside. So we'll keep that in mind as we head towards tomorrow when we will get US trading. The yen is actually on the move a little bit this morning. We see some yen weakness. There isn't much else to talk about in FX markets. FX markets not really moving all that far. 114 is where we trade on euro dollar. 114 is where we trade on the yen, and 114 is also where we trade on euro dollar, but of course with the decimal point in the different place. The Brent price testing a 7-year high, attempting to 85.70 is where we trade there, down by 0.4%. And the Unilever share price, worth keeping an eye on because of this large, fast-moving consumer goods company. It's been tempted to make offers. It's made 3 offers for part of GlaxoSmithKline. It's met with some resistance from investors and indeed from analysts today. Let us get to a chart which caught my eye this morning, and this is to do with what is unnerving some in markets at the moment. That is the pace at which we see yields go higher on US Treasuries. Of course, no US Treasury trading today, but to some extent this has become a bit of a global theme. And the Bloomberg consensus and market pricing now suggesting that we expect over 4 hikes in 2022. So Jamie Dimon says maybe 7. Other voices say fewer, but we will certainly be keeping an eye on how many we get. Interesting to see that consensus and that market pricing just edging upwards. So that's the market narrative. That's where we're really focused at the moment. But in terms of the politics, let's deal with one UK domestic story that is lingering. Boris Johnson faces another bruising week with his future as UK Prime Minister in the balance. This is following a public backlash over rule-breaking parties at his Downing Street office. Reports suggest the Prime Minister is set to lift COVID restrictions in England within weeks. For more on the so-called Partygate fallout, let's bring in David Merritt, who joins us here on set from Bloomberg News in London. David, this won't go away, will it? It does seem as if there's been a long string of supposed scandals that opposition parties have tried to make stick against the ruling Conservative Party or against Boris Johnson, the Prime Minister in particular, and many of those fell by the wayside. But this one has cut through, it seems, and you see the evidence of that in the polling.
Yes, that's absolutely right. But Boris Johnson's personal poll ratings really collapsing over the past week, and with him dragging down, of course, the poll ratings for the Conservative Party. Labour about 10 points ahead at the moment, their best showing for many years. And of course, Boris Johnson's big selling point at the Tory party was his popularity, wasn't it? He was the person who only 2 years ago stitched together this coalition of people who'd never voted Conservative before across large swathes of, say, the north of England, and won that 80-seat majority. Now all of those MPs who've spent the weekend back in their constituencies fielding angry questions about these COVID rule breaches, they're now wondering, is this man no longer an asset, but he's actually a liability?
Absolutely. And so, as you say, he was somebody who could win elections. He wins things. And that's what the Conservative Party liked about Boris Johnson. So if the polls were to stick, that might be something that would worry. What are we hearing about the chances of his survival then? Because it would take, not to get too much into the weeds of the 1922 committee and the way that they oust leaders in the Tory party, but if they wanted to, a number of letters have to be received by one man.
That's right, exactly. And, you know, various reports over the weekend about how many of these letters have gone in, ranging from just in single digits to about 25 already. So maybe we're sort of halfway there. But, you know, clearly, Mr. Johnson isn't going to walk. He's not going to resign. He's clearly committed to sticking to being Prime Minister. So his own MPs are going to have to get rid of him. So, yes, there is this rather drawn-out process that has to go through. Most of them now, though, are saying they're sitting and waiting for this key report. A top civil servant called Sue Gray. She is looking at all these allegations, and she's going to come and report. We're not quite sure when. It could be later this week. It could be next week. Not only MPs, but also Mr. Johnson's own cabinet saying, let's wait and see what she has to say. Why are they doing this? Well, they're trying to buy a bit of time. Is the heat going to go out of this scandal? Is the public going to move on? Maybe we'll see some better news, as you just reported, about COVID restrictions being lifted. Will the Prime Minister get a bit of a bump from that? That's clearly what he's hoping. We're not seeing much of him at the moment. He's rather gone to ground, hoping that some of these things will blow over. But of course, the longer it goes on, there's also a risk that more of these revelations are going to come out. Barely a day goes by without another party being described, another leak to the press. And all of this stuff just fuels the unhappiness, fuels the anger amongst the public, and perhaps makes it more likely that his own MPs will not be able to support him in the future.
And number 10, the residence of the Prime Minister, of course, having to make an apology to the Queen, which is pretty unprecedented over the weekend. All of this certainly lingering on. David, thank you very much for joining us. Thanks to David Merritt for bringing us the latest on that. So with all of that political tension, a possible change of leadership, we'll see where that goes here in the UK. You might have thought that we'd see a lot of pressure on UK assets. That might have been something that we'd learned from years of covering Brexit, for example. But the pound is taking a leg lower for another session, but not really by much. We'll get back to that in just a moment. Another currency to watch, the dollar trading at its lowest level since November, despite an increasingly hawkish Fed. Let's welcome Chris Turner, Head of Foreign Exchange Strategy at ING Bank, and talk about some of these themes. Chris, we'll come to the dollar in a moment. I'll linger on the UK story for just a moment. It seems as if during the Brexit negotiations, and one analyst at Nomura made this point in a note I read, during the Brexit negotiations, it really mattered which individual was leading the Conservative Party, because that could take the country in very different directions. But right now, the pound and that particular UK asset doesn't seem to be moving around based on the fortunes of Prime Minister Boris Johnson. Other things are at play here to do with the Bank of England, to do with stock exposure and people wanting to get into the FTSE 100. So what is driving the pound at the moment?
No, that's exactly it. I think we kind of moved on from Brexit, obviously, in 2016 sort of to 2019, etc. And right now, I think if you look across global FX markets, it's all about inflation and the central banks that are prepared to react to inflation. And I suppose in the developed market space, the Bank of England has been in the forefront there, hiking rates in December and potentially hiking rates against in February. And I think investors have appreciated those central banks that are prepared to move early, and that's one of the reasons the pounds are continuing to do quite well.
So that's one of the reasons the pound continues to do quite well. Do you see that being sustained then, Chris, as we head towards maybe a lifting of some Omicron restrictions, the ones that we do have in place? We don't have very severe restrictions in the UK on a global level, but the ones that are in place, that maybe adds upside to the UK economy. But on the other hand, consumers coming under pressure, a consumer spending squeeze could lie ahead because of higher gas prices and fuel prices. So where do you see the pound heading from here?
Yes, we think the pound is largely going to hold its gains against the euro this year. So euro sterling is currently trading about 83.5 at the moment, and we look for that to move down towards 82 in the second half of the year as the Bank of England kind of hikes rates, probably in February, and then perhaps again another couple of times later in the year. But we'll probably come to the dollar shortly. But I think the strong sterling within Europe can lead to cable, so sterling against the dollar, holding up a lot better than some of the other European currencies. So we have cable trading in a range really between sort of 130 and 140. Currently we're towards the top of that range, but because we're quite positive on the dollar in the first half of this year, we think cable will probably come a little bit lower into the summer.
You're quite positive on the dollar, and apologies to everyone. We have slight issues with Chris's line, but I think we're just about getting the gist of it, so we'll persist for a little while. You're quite positive on the dollar. We have had some weakness on the dollar, though, despite Fed hawkishness, and you might have thought then that the dollar would continue to benefit from that. Do you see us jumping back into the dollar, Chris?
Yes, I do. I think at the start of the year, I mean, the narrative is that all the Fed tightening is priced. Let's look elsewhere on the planet, opportunities in emerging markets, opportunities in commodities again. But I think what's priced for the Fed curve at the moment, the terminal rate at about sort of 1.6% over the next 2 or 3 years. I mean, we speak to our rate strategists, and they would say, the next move there is still probably higher. It's still for the terminal US rate to be priced closer to 2%. That may happen, we think, in the first half of this year. Maybe the Fed dot plots in March or June this year, they help to reprice that cycle. And I think these early stages of Fed tightening, we prefer to back the dollar. And I see the dollar staying strong through this period.
OK, and would that be despite any weakness for the US consumer? Because certainly the US consumer could be under pressure as savings maybe ebb a little bit, as wages struggle to keep up with inflation, as the fiscal impulse is reduced compared to last year, at least for some. What is your expectation of how the US consumer plays into the dollar?
Yeah, it's an interesting angle you mentioned there. I think James Knightley, our US economist, isn't too much concerned about US consumption this year. Consumers have a lot of savings, businesses have a lot of savings, and even though consumer confidence has come down over the last couple of months or so, I think he's looking for pretty strong US consumption this year. So I don't think the Fed will be too concerned about that. But the flip side of that, though, is strong US consumption this year is really driving wider external deficits. So the US current account deficit in Q3 last year was 3.7% of GDP, so very large actually, and that will be the Achilles heel, I think, of the strong dollar story. Now, the point at which the US cannot fund these growing imbalances through strong domestic consumption. Personally, I don't think that's going to be a story this year, because US growth and US interest rates can keep the dollar as an attractive asset, but I think into 2023 that story could turn.
Chris, thanks so much for joining us. Really good to speak to you. Chris Turner of ING Bank joining us there to take us through his thoughts on the pound and the dollar. Some interesting narratives from the FX world so far in 2022. Let us get an update on First Word News Flow, and for that we go to Angel Feliciano in Dubai. Angel.
Anna, the Omicron variant has now spread to major cities in China. Beijing, Shanghai, and Shenzhen have all reported cases. While they're small in number, the infections are causing concern because of their timing. The Lunar New Year begins February 1st and is marked by mass travel. And the Beijing Olympics begin 3 days later. Brent oil has been trading near its highest intraday level since 2014. Futures in London held at about $86 a barrel. Trader Vital Group says the high prices are justified and could rise even further. One reason, concerns about the impact of Omicron on demand have eased. British Prime Minister Boris Johnson faces another bruising week with his political future in the balance. 6 lawmakers in his own Conservative Party have called on Johnson to resign over allegations of drinks parties in Downing Street while the country was locked down. Meanwhile, British media report that Johnson is planning staff changes and a series of populist policy announcements. And in London, bankers have changed jobs in the fourth quarter, got an average salary increase of 19%. That's according to recruiter Morgan McKinley. The pay hikes underscore the surging job market in London's financial district after COVID slowed down recruitment in early 2020. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Anna.
Angel, thank you very much for that update. Let me just get to some breaking news coming through from the drugs maker Moderna. We are seeing Stefan Bancel, who is, of course, the CEO of Moderna, speaking at a virtual World Economic Forum or Davos event. The full Davos, of course, being pushed back to the summer, but there is a limited online event taking place. And we hear him speaking at that event. He's saying that the Omicron-focused shot will be in clinics in a few weeks, which is an exciting development. He was actually on Bloomberg TV just at the end of last week saying that the pandemic could start moving into an endemic phase in 2022. We'll get further analysis of where we are on that road from pandemic to endemic with a voice on the vaccine rollout and on the virus fight a little bit later on in programming. Still ahead this hour, a look at oil as demand pushes higher. We're testing 7-year highs on the Brent oil price. We'll certainly return to that story shortly. This is Bloomberg. Welcome back to Bloomberg Markets. Let's talk about oil prices. Brent oil traded near the highest intraday level since 2014 as the market tightened and concerns about the impact of Omicron ease. For more, let's bring in Bloomberg's Will Kennedy, Executive Editor for Energy and Commodities. Will, very good to have you with us. Just a real-time check on the oil price, 85.81. So we see a little bit of a retreat just now, down 0.3% compared to the previous close. But the direction of travel in 2022 has been to the upside. Is there an expectation that that carries on?
There does seem to be a bullish mood in the market. Oil's up almost 10% already this year, as you mentioned, and I think that's being driven by the sort of the seeming passing of the Omicron wave in Europe, to some extent in parts of America, a realization that perhaps it wasn't going to be as bad as people feared at the beginning of December, where we saw a big sell-off in oil. That's all recovered now. We're testing those 2014 highs. I think on the one hand, there's a lot of optimism about demand. Gasoline demand is strong. People are driving. If the virus is in retreat for a while, people are likely to fly a lot more. And on the other, people are worried that OPEC can't keep raising production forever. There's not enough investment going into fields elsewhere, and the supply may be a little bit constrained. Yeah, let's pick up on those two themes then, on the demand side and the supply side. So it's clear that demand does seem to have been stronger than those who were most fearful had expected in recent months. But there are still questions hanging over China and how the Chinese demand story plays out for the rest of this year. Yeah, no, I think that's probably the one thing that people are concerned about. Clearly, China's still pursuing a COVID zero strategy. So they're locking down provinces, restricting certain cities, and that does make people fearful about whether there will be a downturn in demand there, people driving less, people not flying as much. I mean, so far that doesn't seem to be having a big impact on demand, but that risk, if there was a major outbreak, is clearly there. I think in the rest of the world, demand remains very strong, and what we're seeing in the physical oil market, where people are actually buying and selling ships full of oil, is that refiners are very keen to get their hands on crude oil because they see demand for fuel rising in the first half of this year. And what's the risk on the supply side? Is it that more supply comes back from places that we hadn't seen playing on international markets for some time? Or is it that producers can't live up to the expectations, live up to their pledges? Clearly, 2021 was a period where we saw OPEC put a lot of the supply that they had taken off the market at the early stages of the pandemic, when there was a huge plunge in demand. They slowly fed that back into the market, but quickly this year they will soon reach the limits of what they can do. And we're seeing some OPEC countries already, perhaps in Africa, and even to some extent Russia, being unable to meet the commitments they've made to bring oil back into the market. Saudi Arabia still has spare capacity, the UAE, but I think people are very focused on how much they have left to bring back. And the other thing is that because of the energy transition, investment in oil, new oil fields is not fashionable. That capital isn't going into new fields. There's a concern that we're not replacing the oil that we are using.
Yeah.
And for that reason, people see supply tightness in the years ahead.
OK, well, thanks so much for joining us. Good to have you with us. Will Kennedy, Bloomberg News, with the latest on oil prices. Now, China, clearly a big consumer of oil. China's economic growth slowing in the last quarter as consumer spending took a dive, giving the central bank cause to cut its key interest rate for the first time in almost 2 years. Enda Curran, Bloomberg's chief Asia economics correspondent, gives us an update from Hong Kong.
China's central bank cut 2 key interest rates today in a clear sign that authorities are both concerned about the depth of the slowdown in the economy and that they are now ready to start adding more support to ensure growth gets back on track. The PBOC took that decision at the same time when we got numbers showing retail sales in December continue to slide. That's said to reflect the ongoing outbreaks of the COVID virus across China, which of course necessitates an aggressive response by policymakers to control the spread of the virus. On the flip side, industrial production in December was quite strong, showing that there is a divide going on with manufacturing still strong and consumers remaining weak. But a bigger story is China's economy is starting the new year on a weak footing, and more support from both the central bank and the government is expected.
That was Enda Curran, Bloomberg's chief Asia economics correspondent, with some of the highlights from a large amount of data that we saw coming through from China. Let's get more details on that. Let's bring in Bloomberg's Tom Mackenzie, who follows the China story for us from here in London. Tom, in terms of what we've heard from China, we were just hearing from Enda, one of the dimensions to this was weakness in the Chinese consumer. And you wonder with the threat of Omicron whether that worsens. What was your take?
Well, absolutely. And Oxford Economics coming out and saying that is crucially the weak link for China. Exports have held up. They don't face the same inflationary dynamics as we do here in the UK or the US. It's much more benign, so it gives the PBOC that room to address that by cutting interest rates. But it is the consumer is not back to pre-pandemic levels still, and you're absolutely right. We're seeing, of course, restrictions put in place in cities like Xi'an, the port city of Tianjin. Now you have cases of Omicron locally, local cases in Beijing as well, Guangdong, Shenzhen, Shanghai. So it continues to spread, and of course, as it spreads in China, because it's COVID-0 policies, then they put in these very tough restrictions. It makes it very difficult to go out and consume and buy and go to shops. This, of course, all leading out to Chinese New Year or Chunjie on the 4th of February, when you normally get the biggest mass migration of people that you ever see annually.
Yeah, absolutely. This is usually a big time for people to travel across the country and get together with friends and family. And maybe it won't be. Maybe if restrictions are in place in certain areas. So you listed a whole host of locations where we are seeing the Omicron variant now. And this is really important because this is the heart of the financial world in China. It's the heart of government in China. It's the tech world in China. I mean, Omicron is really getting to the heart of a lot of what we follow from the outside in terms of the global economy.
Absolutely. And for the first time, that is what we're seeing now. The politics, the financial and the tech, as you say. Shenzhen and Guangdong is where the beating tech hub of China. The politics, of course, all centralised in Beijing, and they've had very tough restrictions to try and isolate Beijing, where all, of course, the political leaders are, but also, and this is important for China's global diplomacy, you have the Winter Olympics coming up. They start on February the 4th. As I say, Chinese New Year starts on February the 1st. February the 4th is the Winter Olympics. Again, normally a platform for China to show itself off to the world. They're going to create a bubble around that, but whether or not that holds up during the Games, of course, will be in focus. And this is all in a very important year for President Xi Jinping. The Party Congress is happening in autumn, and we're hoping to cement another third-year term for that Chinese leader.
Whether that bubble is at all leaky that they set up around the Olympics is going to be really crucial. I mean, is there any sense that the zero-COVID policy is weakening, or that it could be reassessed in light of what we know and what we don't know about Omicron, but the experience in the West in vaccinated populations, and China is pretty vaccinated, but with different kinds of vaccines. Is there any sense that could be revisited, that policy at all?
So far, very little sense that you're going to get a revision of that, certainly in the short to medium term. You had Chinese officials coming out earlier today saying that COVID-0 policy is still possible to implement. It seems there's no change on the ground. Some China watchers have suggested that after the Party Congress, towards the end of this year, maybe that is when you're going to get a relaxation. Certainly very unlikely ahead of the Olympics, very unlikely ahead of that Party Congress. And there are those who say, look, China has the toolkit now in terms of track and trace and test to be able to deal with this. Others say that it's unrealistic. They're going to have to make some changes. changes.
Tom, thanks so much. Thanks for the update. Bloomberg's Tom McKenzie joining us with the latest there on China. Coming up on this programme, Jason Draho, head of asset allocation for the Americas at UBS Wealth Management, Global Wealth Management. We will turn to him shortly. We'll get his perspective on how many rate hikes we're going to see this year from the Fed. What will the use of the balance sheet look like? How will both of those things be brought together? What will the inflation fight globally look like in 2022? More on the markets next. This is Bloomberg. It's 1 p.m. in London, 8 a.m. in New York, and 9 p.m. in Hong Kong. Our top stories today. China's growth slows as consumer spending slips, and a surprise by China's central bank. The PBOC eased policy more than expected by cutting 2 key interest rates. Plus, Moderna says an Omicron-focused shot could be in clinics within the next few weeks. We'll bring you the virus latest. And bank earnings underway. We caught up with the Wells Fargo CFO, who says consumers still have a lot of liquidity to grow the economy. That conversation later in this hour. First, welcome to the program, everybody. We will check the markets for you this Martin Luther King Day, which of course means that we are without the United States today. We don't have US equity trading. We also don't have US treasuries trading, but we do have trading here in Europe on both of those fronts, these equity markets and government bonds. So European equity markets moving to the upside, up by 0.6%. And that really just catch up with the United States. US futures are open, and they do point to a higher open when it comes tomorrow, of course. I put in the dollar yen because we do have some movement there, unlike most other areas of G10 FX, where we don't see a great deal of movement. The euro is weaker. 114.01 is where we trade, just 0.1% to the downside. The pound actually a little bit weaker this morning, 136.43. We talked a little about what was going on oil prices earlier with Will Kennedy. A lot of questions about demand from China, but at the moment, the demand story pretty robust. That's sending, broadly speaking, oil prices higher, although they retreat today. And you see the Unilever share price was in there just a moment ago, and we have seen that stock pushing lower by as much as 8% in today's session. A little bit of a lackluster reception to the news over the weekend that particular consumer goods company has made 3 offers for parts of GSK. Now, for the latest on the markets, let's get to Bloomberg's Danny Berger, who has a breakdown for us. Danny, what's caught your eye?
Anna, it really is all about this Fed story and the calls we're getting for shock and awe. And what that means, of course, for the bond market, as you've been pointing out, futures already treading lower. The interesting thing here is that 4 rate hikes seem to be the baseline. We've seen a market that already for the past week has been pricing in 4 rate hikes. Just in the past day or so, it has ticked above 4 rate hikes. Now, strategists, which is this purple line here, have tended to tread behind the market expectations. They too have caught up, seeing above 4 rate hikes for 2022. But will that be enough? Again, I say this is quite the regime shift in that it seems 4 is only the baseline. We heard from Bill Ackman, for example, of Pershing Square, saying that in order for the Fed to regain credibility, it could work towards an initial 50 basis point surprise move to shock and awe the market, which would demonstrate its resolve on inflation. Bill Ackman, of course, isn't the only one. Jamie Dimon as well, saying that he's prepared for as many as 7 rate hikes, saying that, quote, it won't be as sweet and gentle as some expect, Anna.
And Danny, of course, the higher yield environment might give some reason for pause. It might create some uncertainty around risk assets, especially if we see those yields climb really quickly in a short space of time. But one sector that quite likes to see a higher yield environment, or at least a steeper curve, is the banking sector. And certainly that's been a feature of some of our conversations about banks as we get into the earnings story.
Exactly. It really is this interesting meeting between this macro environment, which is friendlier for banks, and the bank earnings, which so far haven't been the most reassuring, perhaps, because expectations are so high. The KBW Bank Index up 11.25% this year. But this was the picture on Friday. We saw Citi and JP Morgan both fall. Wells Fargo does better. Wells Fargo, they did say that their net interest income should rise about 8% this year. So that, again, is that macro story of perhaps a steeper yield curve helping the banks, helping that net interest income. But it's a different macro story that hurt Citi and JP Morgan, and that's the inflation story, specifically wage inflation. costs were much higher for these banks. Again, valuations looking good for JP Morgan to start the year. So that was enough for people to be concerned about what expenses mean for these banks. I should say Jamie Dimon, along with talking about 7 interest rate hikes, said that it's good for workers, it's good for business to rise wages, and also said people shouldn't be crybabies about it, Anna.
Okay, we know that. We are told. Danny, thank you very much. Danny Berger with the latest on how markets are pricing in the Fed and what that does to the yield curve and then the bank earnings story. Let's get some market analysis then this Monday. Let's welcome to the program Jason Draho, Head of Asset Allocation for the Americas at UBS Global Wealth Management. Jason, really nice to speak to you then today. We started there hearing from Danny about the Fed environment, the way the Fed expectations are shifting quite quickly for just how many hikes we get. It seems that the market's expectation, what's priced into markets and the surveys tell us now that more than 4 hikes are expected from the Fed this year. Does that go along with your thinking?
It does. I mean, we're thinking like 3 to 4. But I think what really the Fed is sort of signaling, it wants to get started on hiking policy rates, as soon as possible. So, like, the March timeframe, and probably do a couple of hikes. Well, I think what it's also sort of signaling, and this is a little more subtle, is that it also wants to be, outcome dependent. So, whether it ends up being 3 hikes, 4 hikes, or more than that, according to some, I think that's going to really depend on the data. So getting sort of too precise at this point in time, I think it's almost a little bit, not necessarily that helpful. Also, I think where the market is, to me, is actually a little bit underpricing Fed hikes. It's not so much this year, but it's next year. Because all told, the market's pricing about 6 to 7 rate hikes in its entire cycle, and then the Fed stops. That seems a little too either pessimistic on the long-term growth outlook, or maybe a little too optimistic in terms of how much the Fed actually has to tighten to get inflation under control. All that means, I think, long-end rates ultimately will have to go higher than what they are pricing right now.
So rates will have to go higher. I mean, what's the limit of our expectation here, Jason? We saw JP Morgan's Jamie Dimon saying, look, we could get as many as 7. What would have to happen to take us into that kind of territory, do you think?
Well, there's in some way you can say there's 2 scenarios. One is actually quite good and one is bad. And the bad scenario is that if inflation just continues to stay at a really elevated level, it's not showing signs of coming down, and the Fed realizes they're really far behind the curve and they have to hike rates. The more optimistic scenario is that inflation does moderate, but growth is so strong, the Fed can get to neutral pretty quickly. I think either case is still not great for the market. The latter one, where growth is still actually quite good and allows the Fed to hike, is certainly going to be better for the market, as opposed to the former, where if that's the case, I'd sort of worry about the overall outlook for the market. If the Fed has to do 7 hikes this year, it's really not priced for that. Financial conditions will tighten. I think risk assets at a minimum will become more volatile. We'll probably see some pullbacks. But I think that to me is a really kind of extreme outcome to get 7 hikes this year at this point in time.
So that sounds pretty extreme to you. What about the arguments that we maybe need to see something a little unusual, some sort of shock therapy for markets? Do we need to see a 50 basis point hike in March, Jason? Is that something that we should be talking about? Do you see rationale for the market needing that kind of wake-up call on either the ambitions of the Fed or the commitments of the Fed, or do we need to just shake markets into expecting that the Fed is really serious about tackling inflation? Is there some merit to those arguments?
Well, I think the underlying that argument is to the credibility point, as the Fed sort of lost credibility on its inflation-fighting credentials, and therefore needs to really move aggressively and quickly to get under control. And if you just look at what the bond market's pricing in terms of inflation, sort of medium to longer term, inflation moderates. I mean, we saw the CPI number come out last Wednesday, and actually break-even inflation expectations came down. So if you look at what the bond market is pricing, it's not worried about inflation long term. It's actually more worried about growth. And to me, that doesn't imply sort of a credibility problem for the Fed, at least at the moment in time. So I think to do 50 basis points right now without having the Fed sort of really kind of prep the market for that might be more of a negative for the market than otherwise necessary. Because I don't see the credibility problem just yet, at least from the bond market, what it's signaling to us.
Okay, so you don't see a credibility problem. What kind of problems are thrown up by the fact that we've got the world's 2 largest economies moving in different directions on monetary policy, Jason? What kind of opportunities, perhaps, and also concerns does that throw up? We've got the Fed getting ready to tighten policy. We've got the PBOC just overnight loosening policy, concerns around the retail environment there. What kind of world does that take us into?
Well, I think if we look back in sort of history, and not that far ago, I think in 2018 we saw a situation where the Fed was looking to tighten and the PBOC was looking to ease. So we've had some precedents of where these 2 major central banks are moving in opposite directions. In some sense, you might think that it creates opportunities more in China versus the U.S., but that's certainly not the whole story in terms of what's going to drive risk assets. But I think it does sort of suggest that one, at least for the PBOC, it's a little bit more kind of optimistic scenario for China, at least at the margin, in terms of them willing to ease policy, at least for their risk assets. on a relative basis. And if you contrast that, what happened last year, where U.S. equities did incredibly well, China equities were actually down, largely because of regulatory issues. I think that's, as an investor, you have to think about maybe some sort of mean reversion or reversal in performance there potentially. But for the overall global economy, I think the key story really is, is do we get a bit of reacceleration of growth, hopefully once this Omicron wave, subsides? And is the Fed ultimately engineer sort of a soft landing? I think that's the key point. Is are they sort of looking at the data and will they only tighten as much as the economy needs because they don't want to slow things down too much? I think that's the bigger story for, at least for financial markets, more so than what the PBOC is doing right now.
Okay, and we were also talking with Danny just a moment ago about the banking sector and reports from the banking sector. And clearly we've seen some banks report already, and the cost base was clearly an issue with some, and wages in particular. How much of a narrative is this going to be throughout the earnings season, do you think, Jason? Is it just going to be restricted to financial services professionals who are good at finding inflation numbers on their Bloomberg and taking them to their bosses and saying, this is the real world I live in? Is it just restricted to financial services, or is this going to go much broader?
I think it's going to be a narrative or story for the whole earnings season. I think people were concerned, investors were concerned back in sort of October, November, when Q3 earnings were being reported in terms of the potential inflation impact. And it turns out to be like, the data didn't show that. Company margins actually expanded. Earnings growth was very strong. So that wage pressure inflation really wasn't showing through. But now if we're seeing some sign of financials, maybe that's an issue. And we saw, with, let's say, retail sales last week, maybe some indication that prices going up aren't being matched by wages going up, and that's starting to crimp consumers. So it's possible we could see that starting to show up in the earnings this season. So I think it's going to be a key story because earnings growth is really going to have to drive equity markets higher this year. And if they're being constrained because of rapid wage growth, that could obviously also have a negative impact, at least near term, in terms of the market outlook.
Jason, thanks so much. Good to speak to you. Jason Draho of UBS Global Wealth Management. And now let's get an update on some of the first word news stories we're covering today here at Bloomberg. For that, we go to Dubai and Angel Feliciano. Angel.
Anna, he was the banker whose job was to fix Credit Suisse after a pair of scandals cost it billions. Now, Chairman Antonio Horta Osorio has resigned after just 9 months on the job because of reported breaches of Swiss and UK quarantine rules. Even before news of his quarantine issues began emerging last month, Horta Osorio's leadership style had received mixed reviews within Credit Suisse. He'll be replaced as chairman by board member Axel Lehmann. In China, the central bank has cut a key interest rate for the first time in almost 2 years. Beijing is trying to bolster an economy that has lost momentum because of a property slump and repeated coronavirus outbreaks. Official data show that China's gross domestic product rose 4% last quarter from a year earlier. That's the weakest since early 2020. In Texas, authorities have identified the armed man who entered a Jewish synagogue and took 4 hostages. He was Malik Faisal Akram, a 44-year-old from the UK. The 10-hour standoff ended with the FBI rushing into the building and the death of the suspect. Akram was demanding the release of a Pakistani who was convicted of trying to kill the U.S. soldiers in Afghanistan. And Unilever plans to sharpen its focus on health and hygiene and plans to sell off slow growth brands. That comes at a time when the company is considering whether to increase its $68 billion bid for GlaxoSmithKline's consumer unit. Glaxo has now rejected 3 offers from Unilever. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Anna.
Thanks very much, Angel. And just on that corporate story, she was talking about the Unilever share price down by just over 7% this hour. The GlaxoSmithKline share price up by 3.7%. That in response to the news flow over the weekend that Unilever has made 3 offers. Will they come back with a 4th for part of GSK? Coming up on this program, the Omicron variant has now spread to major cities in China. Beijing, Shanghai and Shenzhen have all reported cases. So we now see a real focus on fighting it in the financial, the government and the tech capitals of China. And Wells Fargo reported tepid loan growth in the 4th quarter. We will hear from the bank's CFO. This is Bloomberg. Welcome back to Bloomberg Markets on Bloomberg TV. Let us talk about energy markets right now. Russian gas flows to Europe have slowed significantly, driving up the cost of energy at a time of peak demand. The impact on household heating bills varies widely across Europe. Let's get some analysis. Jamie Rush joins us now, Chief European Economist for Bloomberg Economics. Jamie, very good to have you with us. And you've done some analysis. So you've come up with some forecasts as to where you think household energy bills across Europe are going to go this year, through 2022. And on your analysis, the UK consumer has some things to worry about. Why is that?
Well, I mean, so the experience in Europe varies quite a lot based on things like hedging practices, for example. So like German utility providers, they buy a lot of their gas many years in advance. It's not the case here in the UK to the same extent. So we're getting more of the pass-through in full to consumers when the price cap is altered in April. So we're going to see a huge lift in the cost of bills for households from April, about a 50% increase we estimate. And that's going to take UK consumers from the most insulated currently to the least insulated from rising gas prices.
OK, and so just to explain that price cap, that's been in place and that has meant that UK consumers have not felt a lot of the increase that we've seen in market rates for gas. But that cap is reviewed periodically. It's going to be reviewed in April, and then we'll see this big increase, 50%, you think, increase in those consumer energy bills. What about over in France? We had some news flow on Friday that was talking about how the French government was requesting certain policy from EDF, one of the electricity suppliers there. What do you look at when you look at France then, the energy mix that they use?
Well, obviously we see more use of nuclear energy there, so that reduces the dependence on gas relative to other countries. And the French state has been making quite a few grants and transfers that have eased the burden on consumers, and that hasn't happened in the UK yet. So that's something we'll be looking to over the next few months to see whether policy does in fact change.
When I look at your analysis, it seems that Spain and Italy, consumers there are the ones who've sort of felt the brunt of the moves right now. You can see them there on that chart in the pink and the blue. And so that's where we've seen the brunt of this being felt already, although you don't expect that to get too much worse from here. What's driving that push higher then in Italy and in Spain?
Well, so more of it is fed through relative to other countries in Spain and Italy, and that's despite measures that were taken. So in Spain, they did big sales tax cuts for energy and so on. So there is support there, and that's why you see, because there isn't any support in the UK, we're going to leapfrog Spain and Italy later this year, because the support just isn't there from the UK government. OK, and
well, we'll wait to see if we get any further support, I suppose, won't we? Because there's a lot of talk here in the UK about a cost of living crisis for various reasons, but heating costs is one of those. What are the other things that are really weighing on consumer spending at this point then, Jamie, here in the UK? Well, I think that's the big one. I mean, we know that restrictions, of course, are making it a little bit harder for people to go and spend money. That's going to be probably changing quite soon. But I think it's actually quite interesting that because of the delay to the feed-through of energy costs, it means that the spike in inflation is going to be prolonged for much longer in the UK than other countries in Europe. So while inflation's settling back at target in the Eurozone, it's actually going to be way over about 4% by the end of this year still in the UK. So it's just a shift in the timing of these things, which could affect central bank behaviour. Jamie, thank you so much. Thanks for joining us. Jamie Rush, Chief European Economist for Bloomberg Economics, with that really interesting analysis of how the UK will fare, the UK consumer will fare up against those higher gas prices. Now, this is, to some extent, a global story, to some extent, a European story. These higher gas prices, certainly a big European focus. EU finance ministers have been gathering in Brussels for the first Eurogroup of the year, with new faces added to the mix, including Germany's Christian Lindner, making his Brussels debut alongside Dutch Finance Minister Sigrid Kaag. The balance of power in Europe could shift then. For more, we go to our European correspondent, Maria Tadeo, who's live on the ground. I know that you've been focused on these new faces and the arrival of them, Maria. I don't know how many people you've had arriving so far. I can see you there in what looks to be the entrance hall. What do these new faces mean to European fiscal policy?
Well, you know, Anna, that's a very interesting question, particularly in this year. We know that the fiscal debate is back at the forefront in Europe. There's a real debate around that 3% deficit, that 60% debt to GDP, and whether or not that could change. And if you know, the market has always been very into this idea that Europe could get spending in bigger numbers. And it's interesting because I did get a chance to speak with the Dutch finance minister, Sigrid Kaag, and she did say, you know, when it comes to frugality, at times it is a good asset, but dynamics and the narrative is changing. changing and we may have to adapt. This is a different government, and as you know, it was the Dutch government led by Mark Rutte that had a very strong line approach to being very fiscally responsible and to not spending way too much. With this new government, that could be about to change.
And I was just talking to Jamie Rush about gas prices and the cost of living in the UK and also across various European geographies, Maria. I know this is something that many of the finance ministers you are busy tracking down in Brussels today, something that they have been thinking about a lot and no doubt having to talk to their constituents, having to talk to their populations about. So prices once again have been jumping for gas and electricity. Are there any new contingencies planned, any new policies that these governments are considering to try and ease pressure on consumer bills?
Well, Anna, it certainly is top of the agenda, especially when you look at countries like Germany, where inflation is always such a tricky issue. For Christian Lindner, he wants to come here and send a very clear message that Germany is all up for price stability. When you look at the French, in particular Bruno Le Maire, this is an election year for the French. And remember, Emmanuel Macron made it clear that by the end of his term, the French would see their purchasing power go up. With inflation, of course, reflecting in higher bills, that becomes more problematic. So in general, there is a sense that inflation could really bite consumers this winter. Now, in terms of what to do with this, there is a real split. Some would argue that this needs pan-European measures, perhaps joint purchases, joint procurement, and others who argue this is about accelerating the green transition. But even when it comes to the green transition, there's also a big debate as to whether that means gas and nuclear to bridge that gap before we go full green. And of course, that is creating tensions already put in the French and the Germans at odds. They see this very differently. One will tell you that gas is the past. The other one argues that gas only takes you closer to Vladimir Putin and Russia, makes you more dependent on them, and that nuclear is really the future.
Yes, absolutely. And you mentioned Russia, and that hangs over every story around European gas consumption at this point, Maria. We see European gas prices actually moving a little bit lower, but Russian gas supply remains in focus and will remain so for as long as we see storage levels quite so low here in Europe.
Yeah, which have been under 50% this year, which is unusual for this time of the year. Now, this is the thing, Anna. We know that Europe is still very heavily dependent on Russia. The flip side, however, and this is sometimes something that I hear, is that this is a short-term situation. We're looking at maybe 1, 2, 3, 4, 5 years down the line, but it will change as the green transition accelerates, and the Russians know that. Having said that, the problem is winter is the time of the year where the European Union, is the most vulnerable to price changes when it comes to gas, and this transition phase also makes it extra vulnerable to changes on that front. And that's perhaps what is not just accelerating these tensions that we're seeing on the price front, but also on the political and the geopolitical front in Ukraine right now.
Maria, thank you so much. Maria Tadeo joining us there from Brussels with the latest on the geopolitics, how it's playing into conversations around energy bills here in Europe. Coming up on this programme, we discuss with Dr. Albert Coe, Department Chair and Professor at the Yale School of Medicine. We discuss the fight against COVID-19, the fight against Omicron. That's coming up next. This is Bloomberg. This is Bloomberg Markets. I'm Anna Edwards. Welcome to a special edition of the programme because, of course, we don't have US equity trading today. But we do have global trading. We do have equity markets open here in Europe. They have been open through the Asia session. And the European session looking to be quite buoyant, actually. The Stoxx 600 up by 0.6%. We don't have a great deal of movement in FX markets today. Tracking dollar-yen, that is one area we do seem to have a little bit of movement. Also, the pound also on the move a little bit today. But broadly speaking, quite a lot of calmness to FX stories this morning. In through the morning session here in Europe. We're now into the afternoon, of course. This is the picture here on the oil price. We're down 0.3%, but we've actually seen that Brent price looking to move up towards 7-year highs, testing levels we haven't seen since 2014. And we've seen oil prices gain some 10% since the start of this year, as the demand story has proven to be a little more robust than anticipated. I put in one corporate news flow story here for you. That is Unilever, the fast-moving consumer goods giant, considering making another offer, according to our reporting for part of GSK. That has some in the market a little bit nervous. Now, let's talk about where we are on the fight against COVID. The Omicron variant has spread to key cities across China, like Beijing and Shanghai. The country faces a growing number of cases despite the government's strict zero COVID policy. For more, we are joined by Bloomberg News' Tim Lowe, who's with us to give us his thoughts. Tim, very good to have you with us. So I just gave some highlights of the latest we've seen on the Omicron variant from China. But of course, this is a global story still. We're seeing it develop very differently in Europe and in North America. In Europe and North America, a conversation has turned to whether this is going to become endemic. So we move from pandemic to endemic. What is your assessment on what that means? What does the world look like? How different is it if we're in an endemic phase?
Sure. Yeah. Well, as you point out, situation much different over here than in China. There's a lot more virus here, and the word endemic implies that the virus will continue to be here for, I don't know, perhaps the rest of our lives. I mean, there's already 4 coronaviruses that circulate the world in an endemic state, and they cause common colds. So in the long run, that's exactly what this one may turn into. It could take a little bit of time before we arrive at that point where we can treat this like the others. And for that to happen, if we're lucky, the population just needs to keep building up immunity through vaccines or through infections. And I think fundamentally in countries where there's a really good level of vaccinations and or the virus has really ripped through, they've already built up a lot of population immunity. You see to some extent in the UK, certainly in South Africa, India, and where I'm sitting here in Germany, where probably aren't quite at that level. Vaccinations have lagged a little bit, and also there probably hasn't been as much virus circulating in the last couple of years as in some other places. So a little bit more vulnerability here, but it's where everyone eventually is going to end up in this endemic state.
And how do we manage then the fact that some parts of the world are not managing the virus in the same way? What breaks in that scenario, Tim? I mean, we see parts of Asia, and this might be the right decision entirely sensibly for their population, or it might not be, but not to pass judgment necessarily on that. But whose policy meets whose? You know, does the Asia policy evolve over the years ahead to look more like the West, but only when it's safe to do so? How do we all come together again?
Yeah, it's a combination of, the virus in the country, how it's circulating and hitting people, how vulnerable the population is. If you have a younger country, you might not have as much risk of fatality. And most importantly, what the policymakers decide and population decide what level of virus they're willing to tolerate at any given point. In Europe and in the Americas, it's been a higher level than in a lot of countries in Asia. But, the virus, you can't keep these things out forever. You can't keep the flu out. You can't keep colds out. And it's going to circulate and hit every country. So eventually the urgency of the crisis will subside and countries will have to figure out to what level they can sort of open the door more and more comfortably.
Yeah. Okay, Tim, thanks so much for joining.
And not doing so, there are potentially economic costs. Sure.
Tim, thanks so much for joining us. Bloomberg's Tim Lowe with the latest on the various fights around the world that we're seeing against COVID-19. And it's not just in China. Governments around the world are grappling with the same question. What comes next in the pandemic? With us now, Albert Ko, Department Chair and Professor of Epidemiology and Medicine at the Yale School of Medicine. Dr. Ko, very nice to have you with us. And we were just talking there about the way that this might be becoming, Professor Ko, sorry, how this might be becoming endemic in certain parts of the world. What does it mean to you, Albert, for this to become endemic?
Well, so endemic means that we're having constant transmission in all parts of the world. And obviously, this is going to be the case with the COVID virus. It's too highly transmissible. We are not going to be able to eliminate or contain it, and containing it at a level where it maybe causes small clusters or epidemics. And that's certainly true with the Omicron wave. If there's anything that we've learned, we had a supercharged variant, the Delta variant, which was much more transmissible than the ones that we had encountered in the initial phase of the pandemic, but now we have one which, the Omicron is twice as transmissible as Delta.
Yes, indeed. And sitting here in London, we're certainly very familiar with just how transmissible it is. I'm reading some lines coming through from Anthony Fauci, the top medical advisor to the US president, who's saying that it's too soon to say that Omicron heralds the end of the pandemic. Can we link Omicron with the end of the pandemic at all, Albert? Or is it, as Dr. Fauci there says, just too early?
Yeah, I think Dr. Fauci is correct on that one. It's really too early. It's really, if there's anything that we've learned from this pandemic, is what's going to drive these waves, these surges through regions are going to be new variants. We've seen this with the Alpha variant that started that was first identified in UK. We saw it with the Delta variant in India and the Omicron variant in South Africa. And if there's anything that we've learned is that, for the future, is that we're going to have future waves of those. And the key issue here is that because we're already dealing with a highly transmissible variant at this point, and currently our vaccines as well as natural infection don't provide high levels of transmission blocking immunity, although it does reduce the risk of severe disease. It's going to be very hard to kind of control this, and so this is certainly going to drive this into this endemic phase of transmission.
What do you think of the way that this is being managed then? I mean, you can speak about the United States if that's what's most familiar to you, Dr. Koh, but also here in UK there are some similarities, I suppose. We seem to be managing this, so as long as hospital systems can cope, are we doing our populations a favour to allow large swathes to become exposed to what seems to be, for those who are vaccinated at least, a milder version of COVID-19? Or would that be to misinterpret the science?
No, I think, Anna, that's right. And we actually have two polarized views of how to approach the pandemic or this current wave. One is the zero COVID containment, complete containment policy, as was illustrated early in the program in China. And the other is kind of the let it rip strategy. And the answer is really in the middle. The zero COVID policy is going to be untenable just because of biologically, because of the high transmissibility of Omicron. It's going to be impossible to control with non-pharmaceutical interventions together with vaccination. On the other hand, the let it rip strategy, the big problem in what we're experiencing here in the United States is that even though Omicron is less severe, because it's so transmissible, it's going to translate into large numbers of people infected, large number of hospitalizations, and eventually deaths. So we're going to have to, at this point, toggle between those two policies in order to not overwhelm our healthcare systems, and also, most importantly, lead to loss of life.
Do you think that new variants, as they emerge, will generally produce milder symptoms, Dr. Koh? And if they do, will that be because it's in vaccinated populations, or will it be because they are just, of their nature, becoming milder, these variants?
Yeah, so the emergence of these variants are what we call a highly stochastic or a random process. I think a good example is Omicron. We all thought, many of us had thought, that if we're going to have a variant, it's going to be something that's derived from the Delta variant, which spread over and outcompeted all other strains and variants in the world. But this came out of the blue in a completely separate lineage. So, I would urge caution in trying to predict whether this is going to be less virulent, more virulent. And I think the most important thing is that we have to prepare ourselves for, new variants as they emerge, and potentially ones that may be more virulent, or as well as ones that potentially may escape our immunity due to vaccination.
And where would that leave us then, Dr. Koh? That would leave us requiring a new round of vaccinations, I suppose, tailored to that specific variant. Because so far with Omicron, yes, I know the scientists are working on that, but we seem to have managed to fight it with very high case numbers, even without those specific Omicron-tailored vaccines.
So all of us are exhausted, with the pandemic. We're going into our third year, but I think the key issue here is not to take our foot off the pedal as we did in previous steps of the wave. We're going to have to still ramp up vaccination to all segments of the population, parts of the world. Here in the United States, only 60% of the population have been fully vaccinated, 25% have gotten boosted. We're going to have to, the key issue here is saving lives and, in relieving our healthcare systems here in the United States, but throughout the world. And one important issue is going to be getting oral antiviral agents out to many parts of the world's population so we can mitigate the burden of severe disease and the deaths that we want to prevent. And in order to do that, we're also going to have to decentralize testing, not here just in the industrialized country, but much of the world. And as you mentioned, Anna, we're going to have to get better vaccines. We need to still do the hard work, and we have good vaccines that reduce the risk of severe disease, hospitalizations, and deaths. But we need, we're going to have to strive for vaccines that potentially are transmission blocking, like we have against measles, mumps, and rubella.
Dr. Ko, thanks so much for your time. Dr. Albert Ko of the Yale School of Medicine, thank you very much for joining us. Let us get a First Word News update. For that, we go to Dubai and Angel Feliciano. Angel.
And British Prime Minister Boris Johnson faces another bruising week with his political future in the balance. 6 lawmakers in his own Conservative Party have called on Johnson to resign over allegations of drinks parties in Downing Street while the country was locked down. Meanwhile, British media report that Johnson is planning staff changes and a series of populist policy announcements. In London, bankers who changed jobs in the fourth quarter got an average salary increase of 19%. That's according to recruiter Morgan McKinley. The pay hikes underscores the surging job market in London's financial district after COVID slowed down recruitment in early 2020. And Brent oil has been trading near its highest intraday level since 2014. Futures in London held at about $86 a barrel. Trader Vital Group says the high prices are justified and could rise even further. One reason is concerns about the impact of Omicron on demand have eased. And Amazon has made a last-minute reversal. It will not ban the use of Visa credit cards issued in the UK. Amazon had previously said it was taking this step because of the rising cost of Visa credit cards. The ban was set to take place Wednesday. Amazon says it's working with Visa on a potential solution. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Thanks very much, Angel. Angel Feliciano with your First Word News update coming to us from Dubai. Still ahead on the programme, we continue to watch earnings roll out from the largest US banks this week, and lending has been a key focus for investors after demand lagged for much of 2021. We bring you some of Bloomberg's conversations. We will bring you comments from the CFO of Wells Fargo next. This is Bloomberg. Welcome back to Bloomberg Markets. Wells Fargo reported tepid loan growth in the fourth quarter, but said that borrowing is likely to pick up this year as clients start to take on debt again and government stimulus wanes. The CFO of Wells Fargo, Mike Santamassimo, told Bloomberg TV that consumers still have a lot of liquidity to grow the economy.
We did see in the quarter continued, progress in the recovery, and I think you saw that through the loan growth that we saw. And it was really across the board, both on the consumer side as well as the commercial side. On the consumer side, we saw growth in auto, in cards, underneath we saw some growth in our non-conforming mortgage portfolio as well. And so we finally started to see some of that growth materialize, which I think will be a good thing.
Mike, just one quick follow here. On the auto loans, can you kind of give us a little bit more perspective there? Because I did see that, if I'm reading the data correctly, that a lot of it was higher value of the loans themselves. Was the volume in loans also higher?
Yeah, we had a record origination quarter again, third quarter in a row in the auto business. Now, about 2/3 of our auto business is used cars. So we are benefiting from higher used car prices, but we're also seeing that volume be really strong there as well. The new car market's a little more constrained, but we're seeing that growth really come through in the used used car volume, which is good given the mix of our business.
On one hand, you have inflation, which could impact consumer spending, and on the other hand, you have higher interest rates. And I'm wondering how much those higher interest rates could potentially stifle some of this loan growth and deter some of the consumers from taking on more loans.
Well, I think you have to first start with the fact that we're talking about raising rates means that we have a really strong, economy underneath it. And you see that, in consumer spending, you see that in sort of the equity markets, you see that in, loan growth, as we sort of talked about. And coupled with that, consumers still have a lot of liquidity. It may be off the peaks that we saw, a couple of quarters ago, but still on average, maybe 30% more in consumer deposit accounts. So that really should help, consumers continue to be out there growing the economy. Now, rates, again, will be helpful for us, and we've talked about that in terms of our net interest income. But I think it's a good sign that, the economy continues to be pretty strong underneath it, which should be good as we look through the rest of the year.
Beyond the consumer business, you did show some strides in your investment banking business. I'm really curious, Mike, about specific plans to potentially grow that business more into this year and how competitive you think you could be.
Yeah, well, look, we think we have a lot of opportunity in the investment banking business, in particular, as you sort of think about going after the opportunity to work with our middle market and commercial banking clients, where we have a really great market share. And we've talked about that opportunity for the last, few quarters. So we think there's a lot of room for us to continue to grow. We're adding people both in the commercial bank in the investment bank. And that's in the context of us continuing to execute on our efficiency initiatives and agenda. While we're still able to get costs down, we're able to make those investments to go after that opportunity, which we think will be significant over time.
And talk to us about those investments in getting that talent, adding those people where you want to expand. You're talking about $500 million in wages and benefits inflation. How are you having to compete for the right sort of talent right now, Mike?
Yeah, well, it's certainly a competitive market, and we've seen some wage inflation, and that $500 million is above and beyond kind of the normal increases we see in pay each year. And part of that is us increasing our minimum pay across the board to somewhere between $18 and $22, depending on where you are in the country. And we're really seeing that part of it have an impact on, both recruiting and retention across that part. And we're going to continue to have to be competitive there, but we still think that, we're able to do that. We've seen good ability to attract people to the platform. And again, that's still in the context of us being able to manage overall expenses down as we look at 2022.
That was the Wells Fargo Chief Financial Officer, Mike Santomassimo, on Bloomberg Markets The Close, speaking to us on Friday. And of course, we can look back to what we learned on Friday about the bank earnings story. We can also look forward because we have a number of banks reporting this week. For more on US bank earnings season, let's go to Bloomberg's Michael Moore, who joins us once again with thoughts on this. And let's pick up where we heard there from the CFO of Wells Fargo. It wasn't concerns around high levels of expense and costs that weighed on the share price of Wells Fargo. In fact, their share price was higher by the close on Friday, Michael, but it did weigh on other banks. It certainly weighed on JP Morgan. How much is this idea of higher compensation, higher wages and other payments to staff going to be a real dominant theme this quarter?
I think it will be a strong theme throughout the quarter. It's something where, a lot of investors are focused on it because it's one of the few levers that the banks have full control over. You heard them talking about interest rates and the broader economy, and banks are often really reacting to that and don't have as much control there, but they do have more control on the cost side. But we've seen that pressure build throughout the year, whether it's whether junior investment bankers, more senior folks we reported on last week, Goldman having to pay more to their partners. There does seem to be a very hot job market, both on the sell side and the buy side on Wall Street. And that is, you're seeing that reflected in the bank's results.
Okay. So that's something that we'll continue to focus on as we go through the US earnings season, Michael. Something else that the CFO of Wells Fargo mentioned was the higher interest rate environment, the steeper curve, what that does to net interest margins. This is something that, as you say, they don't do anything about that, but they'll be happy to take the benefit, I'm sure. What kind of impact will this have on the various banks we're following?
Well, I think, broadly, the interest rate environment is helpful to banks as we see it creep up. But the big question out there is, what is the trade-off with loan demand? Loan growth starting to pick back up, as some of the stimulus rolls off. But, it's kind of tug of war and what will win, the higher cost to consumers as interest rates go up, or the stronger economy presenting more opportunities for them to borrow. So I think that's something investors will be watching.
Yeah. And you wonder how quickly we'll see that loan growth story return, Michael, if, as the CFO of Wells Fargo was saying, if we're still seeing deposits, consumer liquidity, still 30% higher than you would normally expect it to be. That was something that weighed down on loan growth in prior quarters.
Yes, I mean, with stimulus payments, with the child care tax credits, there have been a number of things that have affected the consumer balance sheet. A lot of them have paid off credit card debt during this period. There's less travel expenses, things like that over the last couple of years. So, how quickly that picks back up, that will be a big driver for the banks, because they've had a tremendous run over the last 18 months in terms of their share price.
Michael, thank you so much. Thanks for joining us. Michael Moore, Bloomberg's Michael Moore, with the latest on the US earnings season. Let us just tell you where we are across European equity markets right now, moving to the upside, up by 0.6%. More on the markets in our conversation still to come. Peter Chatwell, Mizuho head of multi-asset strategy, will be with the team to take you through what he sees on these markets. Perhaps a focus there on fixed income markets. We don't have Treasury trading today. We have futures, though, suggesting that yields are still heading higher. This is Bloomberg. Welcome back to Bloomberg Markets. Wells Fargo reported tepid loan growth in the fourth quarter, but said that borrowing is likely to pick up this year as clients start to take on debt again and government stimulus wanes. The CFO of Wells Fargo, Mike Santamassimo, told Bloomberg TV that consumers still have a lot of liquidity to grow the economy.
We did see in the quarter continued, progress in the recovery, and I think you saw that through the loan growth that we saw. And it was really across the board, both on the consumer side as well as the commercial side. On the consumer side, we saw growth in auto, in cards, underneath we saw some growth in our non-conforming mortgage portfolio as well. And so we finally started to see some of that growth materialize, which I think will be a good thing.
Mike, just one quick follow here. On the auto loans, can you kind of give us a little bit more perspective there? Because I did see that, if I'm reading the data correctly, that a lot of it was higher value of the loans themselves. Was the volume in loans also higher?
Yeah, we had a record origination quarter again, third quarter in a row in the auto business. Now, about 2/3 of our auto business is used cars. So we are benefiting from higher used car prices, but we're also seeing that volume be really strong there as well. The new car market's a little more constrained, but we're seeing that growth really come through in the used used car volume, which is good given the mix of our business.
On one hand, you have inflation, which could impact consumer spending, and on the other hand, you have higher interest rates. And I'm wondering how much those higher interest rates could potentially stifle some of this loan growth and deter some of the consumers from taking on more loans.
Well, I think you have to first start with the fact that we're talking about raising rates means that we have a really strong, economy underneath it. And you see that, in consumer spending. You see that in sort of the equity markets. You see that in, loan growth, as we sort of talked about. And coupled with that, consumers still have a lot of liquidity. It may be off the peaks that we saw, a couple of quarters ago, but still on average, maybe 30% more in consumer deposit accounts. So that really should help, consumers continue to be out there growing the economy. Now, rates, again, will be helpful for us, and we've talked about that in terms of our net interest income. But I think it's a good sign that, the economy continues to be pretty strong underneath it, which should be good as we look through the rest of the year.
Beyond the consumer business, you did show some strides in your investment banking business. I'm really curious, Mike, about specific plans to potentially grow that business more into this year and how competitive you think you could be.
Yeah, well, look, we think we have a lot of opportunity in the investment banking business, in particular as you sort of think about going after the opportunity to work with our middle market and commercial banking clients, where we have a really great market share. And we've talked about that opportunity for the last few quarters. So we think there's a lot of room for us to continue to grow. We're adding people both in the commercial bank in the investment bank. And that's in the context of us continuing to execute on our efficiency initiatives and agenda. While we're still able to get costs down, we're able to make those investments to go after that opportunity, which we think will be significant over time.
And talk to us about those investments in getting that talent, adding those people where you want to expand. You're talking about 500 million in wages and benefits inflation. How are you having to compete for the right sort of talent right now, Mike?
Yeah, well, it's certainly a competitive market, and we've seen some wage inflation, and that $500 million is above and beyond kind of the normal increases we see in pay each year, and part of that is us increasing our minimum pay across the board to somewhere between $18 and $22, depending on where you are in the country. And we're really seeing that part of it have an impact on both recruiting and retention across that part. And we're going to continue to have to be competitive there, but we still think that we're able to do that. We've seen good ability to attract people to the platform. And again, that's still in the context of us being able to manage overall expenses down as we look at 2022.
That was the Wells Fargo Chief Financial Officer, Mike Santomassimo, on Bloomberg Markets The Close, speaking to us on Friday. And of course, we can look back to what we learned on Friday about the bank earnings story. We can also look forward because we have a number of banks reporting this week. For more on US bank earnings season, let's go to Bloomberg's Michael Moore, who joins us once again with thoughts on this. And let's pick up where we heard there from the CFO of Wells Fargo. It wasn't concerns around high levels of expense and costs that weighed on the share price of Wells Fargo. In fact, their share price was higher by the close on Friday, Michael, but it did weigh on other banks. It certainly weighed on JP Morgan. How much is this idea of higher compensation, higher wages and other payments to staff going to be a real dominant theme this quarter?
I think it will be a strong theme throughout the quarter. It's something where, a lot of investors are focused on it because it's one of the few levers that the banks have full control over. You heard them talking about interest rates and the broader economy, and banks are often really reacting to that and don't have as much control there, but they do have more control on the cost side. But we've seen that pressure build throughout the year, whether it's whether junior investment bankers, more senior folks, we reported on last week, Goldman having to pay more to their partners. There does seem to be a very hot job market, both on the sell side and the buy side on Wall Street. And that is, you're seeing that reflected in the bank's results.
Okay. So that's something that we'll continue to focus on as we go through the US earnings season, Michael. Something else that the CFO of Wells Fargo mentioned was the higher interest rate environment, the steeper curve, what that does to net interest margins. This is something that, as you say, they don't do anything about that, but they'll be happy to take the benefit, I'm sure. What kind of impact will this have on the various banks we're following?
Well, I think, broadly, the interest rate environment is helpful to banks as we see it creep up. But the big question out there is, what is the trade-off with loan demand? Loan growth starting to pick back up, as some of the stimulus rolls off. But, it's kind of a tug of war and what will win, the higher cost to consumers as interest rates go up, or the stronger economy presenting more opportunities for them to borrow. So I think that's something investors will be watching.
Yeah. And you wonder how quickly we'll see that loan growth story return, Michael, if, as the CFO of Wells Fargo was saying, if we're still seeing deposits, consumer liquidity, still 30% higher than you would normally expect it to be. That was something that weighed down on loan growth in prior quarters.
Yes, I mean, with stimulus payments, with the child care tax credits, there have been a number of things that have affected the consumer balance sheet. A lot of them have paid off credit card debt during this period. There's less travel expenses, things like that over the last couple of years. So, how quickly that picks back up, that will be a big driver for the banks because they've had a tremendous run over the last 18 months in terms of their share price.
Michael, thank you so much. Thanks for joining us. Michael Moore, Bloomberg's Michael Moore, with the latest on the US earnings season. Let us just tell you where we are across European equity markets right now, moving to the upside, up by 0.6%. More on the markets in our conversation still to come. Peter Chatwell, Mizuho head of multi-asset strategy, will be with the team to take you through what he sees on these markets. Perhaps a focus there on fixed income markets. We don't have Treasury trading today. We have futures, though, suggesting that yields are still heading higher. This is Bloomberg.